Let me ask you something. What's the most powerful ingredient for financial success? Is it being a genius, having a fancy degree, or is it something way simpler, something that's actually available to all of us? Well, the answer might just change how you think about money forever.
So where are we getting all this from? These incredible lessons come straight from Morgan Housel's best-selling book, The Psychology of Money. And the big idea here is that getting good with money has less to do with what you know and way more to do with how you behave. It's not about spreadsheets, it's about stories.
And to really get this, we've got to start with the story. It's a real-life puzzle, really. A tale of two men whose financial lives went in completely, and I mean completely, opposite directions.
Okay, let's meet our two guys. On one hand, you've got Ronald Reed. He was a janitor and a gas station attendant. Lived a really simple, humble life. On the other hand, you have Richard Frisconi. This guy was a total opposite. Harvard MBA, a top executive at Merrill Lynch, living in a massive mansion with, get this, 11 bathrooms and 2 pools.
Now, you probably think you know how this story ends, right? But here's where it gets crazy. Ronald Reed, the janitor, died with a net worth of over $8 million, and he left most of it to his local hospital and library. Meanwhile, Richard Friscone, the Wall Street executive, went completely broke after the 2008 crash and lost everything.
So, the big question is, how is that even possible? How does a man with zero financial training and a regular job build an $8 million fortune, while a guy with every possible advantage ends up with nothing?
And the answer gets right to the heart of it all. Financial success isn't really about how smart you are. It's about how you behave. It's a soft skill. And it turns out, patience can be way more powerful than a PhD.
So what was the behavior that made all the difference? Well, Ronald Reed managed to tap into this unseen, almost magical force in finance. A force that, if you give it enough time, can turn tiny little molehills into massive mountains.
That force is called compounding. It's like a snowball. You start with a little bit of growth, and that growth becomes the fuel for future growth. Your money starts making money, and then the money your money made starts making its own money. At first, you barely notice it, but give it a few decades and the results are just mind-blowing. They defy logic.
And as it turns out, this is the exact same secret that explains the wild success of maybe the most famous investor of all time. Yep, we're talking about Warren Buffett. His story is the perfect example of the unbelievable power of compounding when you mix it with one crucial ingredient: time. So Warren Buffett's net worth is around $84.5 billion. It's a number it's hard to even wrap your head around. But the most interesting thing about that number isn't how big it is, it's when he actually earned it.
Look, Buffett was a great investor his whole life. He started when he was just 10. By 30, he was a millionaire. By his 50s, he had hundreds of millions. That's amazing, right? But all of that, and I mean all of it, was basically pocket change compared to what happened next. The truly explosive, legendary growth didn't really kick in until very, very late in his life.
Which leads to this wild question. Buffett became eligible for Social Security in his mid-60s. So out of that gigantic $84.5 billion fortune, how much do you think he earned after that point?
The answer is, it's almost hard to believe. $81.5 billion. Over 96% of his entire net worth came after his 65th birthday. Now, that's not just a fun fact. That is the entire secret. His fortune isn't just a story about being a genius investor. It's a story about longevity.
And that's the key lesson right there. As Morgan Housel puts it so perfectly, his skill is investing, but his secret is time. Think about it. If Buffett had started in his 30s and retired in his 60s like a normal person, you and I probably would have never even heard his name.
This whole idea that patient consistency can crush short-term brilliance, it becomes even clearer when you look at a kind of modern-day financial version of the tortoise and the hare.
Okay, check this out. There's an investor named Jim Simons. The guy's an absolute legend, compounding money at a ridiculous 66% a year. That's 3 times better than Buffett's average. Yet, Buffett is more than 3 times richer than him. How? Well, the answer is right there in that year's investing column. Simons really hit his stride at 50. Buffett has just been in the game for over 75 years.
So here's the point we really need to get. Buffett's real superpower wasn't just his stock-picking skill, it was his endurance. He is the richest investor not because he earned the absolute highest returns, but because he earned pretty good returns for the longest period of time.
So, what does this all mean for us?
What's the actual lesson here? It's that success isn't always about being the absolute best. A lot of the time, it's just about having the power to stick around.
You know, so much of success is about what you avoid doing. Buffett didn't get wiped out by debt. He didn't panic and sell his stocks during the 14 recessions he's lived through. He didn't burn himself out or chase crazy fads. He just survived. And that survival is what gave compounding all the time it needed to go wild.
And that brings us to what might be the single most important sentence in the entire book. Good investing isn't about earning the highest returns. It's about earning pretty good returns that you can stick with for the longest period of time. That's the magic formula. And once you really get that, it should change everything about how you approach your own money. It means most of us have been asking the completely wrong question. The goal isn't, how can I get the absolute highest returns this year?
The real question, the better question, is this. What is a good, solid financial plan that I can actually stick with for decades? It's not about finding the perfect strategy. It's about finding a good one that you won't give up on when things get scary. Because in the end, financial success isn't about timing the market. It's about time in the market.